Hey guys, Mike here. So sorry if my voice sounds a little funny, but been under the weather the last couple of days, and so apologize about that. But obviously we got the Fed meeting coming up tomorrow, so we get to see if they're going to do 75 basis points or a full percent. And I think obviously the market, which I'll show you, is definitely betting on 75. But we're going to go over that, a pattern that has formed over the last 3 meetings that I'll show you if you're looking to do a short-term trade. And then other things we have to be looking at after they announce this Fed rate hike. That's extremely important. And you can see right here, obviously around 82% are expecting a 75 basis point hike, and then around 18% are expecting a full basis point hike. And something to keep in mind here as we go through this is look at what's coming up here. We got the meeting tomorrow, but guess what? No meeting in October. So what does that do? That clears the path. That's why a lot of people are calling for some sort of rally to happen after the meeting, because it's happened the last few times, but also because what's been happening. A lot of shorts have been putting in, a lot of people are buying puts, all this stuff, and then when everybody gets super bearish, we usually go the opposite route. And when you look at that, you look at negative catalysts to come up. Well, the only negative catalysts really left are going to be earnings, right? And so that's why you saw a company like Ford, for example, came out today and just tanked their stock because they did exactly what FedEx said, warned about inflation, other issues. And so they're taking the hit now versus waiting until they actually report earnings. I think you're going to see more and more companies doing that. And NVIDIA did it. Obviously, I've showed you a bunch of companies that have done it. But the one pattern I wanted to show you, and I got these 3 side by side during every Fed meeting over the last 3 times here. This is May, June, July. May's to the left, July's all the way to the right. But you can see right there, they all 3 look pretty much identical. You see the huge candlestick, a lot of buying going up as soon as he starts to run his mouth. That's Jerome Powell I'm talking about. And then sells off, same thing. Jerome opens his mouth, boom. And then when he stops speaking pretty much, they tank. And then, of course, this is the latest one right here. Not as big a candle, but it still went up between, I think that was about 1.5%. The others were 3. And then sold off to the next day. And if you get anything out of this, guys, please hit that like, subscribe button. I really appreciate it. And so some things to pay attention to after tomorrow and the coming up weeks here are, one is going to be the rates, right? The 10-month, 3 year is the big one. But, all these are inverted already except for the 3-month, 10-year. And just look how close it is now. Looking at the 3-month at 3.25%. The 10-year at 3.54%. I think that's the closest they've been. And when I looked on the Fed website, it is extremely close to inverting. And the reason why people are so focused on the 3-month 10-year versus the 2-year 10-year, because of the 2-year 10-year inverts, you're looking at take up to 2 years before you get a recession. The 3-month 10-year is much more accurate, and you're talking anywhere from 3 to 12 months when you get the recession, and most people are calling for it in Q1, Q2, and so again, we're only 3 months to the end of the year. Believe it or not, it's kind of shocking, right? This year has flown by, and so that's something we got to really keep an eye on. And the other things you got to think about is, I've been talking about this before, but just to show it to you, this is now that interest rates are going up. The interest expense on the U.S. debt now is at $716 billion, and understand, basically a year and 4 months ago, it was sitting at around $482 billion. So it's a huge increase. And that's important because the biggest line item in the federal deficit, or federal budget, is Social Security. That's at $1.2 trillion. They're going to keep raising rates. So the biggest line item pretty soon is going to end up being the interest on the debt. Right? I know some people think deficits and debts just don't matter, blah, blah, blah. But it does. And understand, if you're spending this much on interest to, fund the debt, that's other things that have to get cut. It just has to, right? That, or you just keep running up the debt until it's just, we're already astronomical, right? At 30 trillion. So, but it's not good. And so just to give you a visual of what I've been talking about, this is what we're talking about, okay? It's not a good thing. It's the reason why they hadn't done it in the past. They tried to avoid it, right? And the reason why we say these rate hikes are so much different than any time in the history of our country, because we've never had anywhere close, as I've showed you, the amount of debt we are carrying right now as a country. Not even close, okay? And so that's the big thing. The other one to keep in mind is this right here. We have never hit a market bottom before the Fed stops raising rates. And if you don't believe me,
we have never had a bottom in a stock market without the Fed, while the Fed is still raising rates.
Never.
Never.
Never had a bottom in the market while the Fed is still raising rates.
That's right.
And from all my research, that actually is true. And so again, we're supposed to be raising rates until at least December, right? And so, maybe another 50 basis point, 25 basis point, whatever it is. But, that's significant to understand. And then we don't know what we're going to do in 2023 at this point in time. Because remember, they're starting to roll off the balance sheet if it actually starts to roll off. They haven't, rolled off hardly anything compared to what they were supposed to have been rolling off since June. So we'll have to see if they're correct and the pace actually does pick up. That's going to be key. And then how the market actually handles that. And, just to give you another visual of something here, retail sales, when we talk about the economy, right, is this right here. You got food and service sales year over year, unadjusted for inflation. You see where it's at right there, 9.1. Look what happens when you adjust it for inflation. That is a huge gap. This chart goes all the way back to the early 90s. You never see a gap that big. But that's why sales may look positive, but once you take into account we're just paying more for these items, then sales do not look so hot at all. You can see how low they actually are. They're lower than they've been since basically 2010, seems like, if you take out the 2020 crash. And so, again, I've showed you multiple models that, yes, we're in contraction phase of the economic cycle. That's why it's important to pay attention to the economic cycle. What's throwing it off is all the money and the liquidity still out there. But, there's some good news on the front, like, Canada's core inflation and headline inflation rolled over, right? Or peaked or whatever you call it. It decreased. But then you got Germany, hot mess. Headline still increasing, core still increasing. They're about to nationalize, an energy company or something over there. They try to stabilize energy prices and stuff. And so, you just never seen these bankers be so hawkish and all be raising rates at the same time, right? And so that's why this makes for interesting times. But in the short term, just so you know, a lot of people are calling for one of these, short-term rallies because things, have gotten oversold and a lot of people are short in the market. And when everybody thinks the market's going down, it usually does the opposite in the short term. But in the long term, everybody expects, it just makes sense the market would continue to go down as more and more companies, I think, will really start to roll out and take their medicine and their lumps before actual earnings. But then again, the conundrum is, what happens if earnings don't roll over as bad as we thought they were, just like we just went through in the second quarter? Everybody thought the earnings were going to be just disastrous, and I kept saying, well, the bar's on the ground, so all they got to do is trip over it, right? And that's what happened. Most of them just tripped right over the bar, fell forward, and they went, everything's great, and we took off. And so, but with these Fed meetings and these short-term rallies, it's kind of like this process we go through where we got the sell-off happening, and then what happens? Everybody, phase one, short the heck out of the market, push it down, sentiment's diving, everybody thinks the world's coming to an end. And then phase two is hedge funds start pushing it back up, forcing shorts to cover, which means they got to buy back all that stock, and it just takes off. Phase two, then you get people FOMOing in because, oh my God, it's leaving without me. This was it, and they start FOMOing in. Then you got phase three, which was the news media starts coming out saying it's a bottom, everybody get in, and then that makes more people get in. And then of course phase four is rinse and repeat, and all of a sudden something will come out and they'll say, oh, the Fed didn't pivot. They'll start painting a narrative of whatever, whether it's the Fed pivoting, the Fed's going to stop raising rates in December, is something that's not even factual. Right, just to try to paint a narrative of why the market should just start going to all-time new highs, right? That's kind of where we're at. And so, we'll see what happens, and, just watch out for that. If you start seeing people paint a narrative and say, well, the market if it starts to rally hard again, it's like we did in June, and, short start covering all this stuff, just watch for the narrative, which is, I assume this next narrative is not going to be a pivot. It's going to be, oh, they're going to stop raising in, December, so they'll be done and just hold rates. And so therefore that's the reason for the market to pivot, because it's 6 months ahead of the economic cycle or whatever. But Anyway, we'll see. Just pay attention to that. And so I hope you got some out of it. Hit the like, subscribe if you did. Hopefully tomorrow my voice will be back to normal. I hope. And because it sucks being sick. So anyway, have a good one, guys. And I'll see you tomorrow.